So it's 8 o'clock, so why don't we continue? Um, everyone can hear me, right? One thing that I did not mention, or one thing that I wanted to mention is that as aspiring accounting professionals like you guys, um, that I wanted you to understand what your job will entail as you're going forward with your profession. So this was one of the examples. So as a student in MBA class or master students, you're learning accounting principles and accounting rule. I don't want to call it rules or standards and principles. There are going to be challenges as you pursue your career in terms of interpreting the accounting principles and accounting standards and how you apply those accounting principles and standards into the real world journal entries. And this is one of the examples that I wanted to provide you what you should expect as you proceed with your professional career in accounting. So like I said previously, even though it may look like a vehicle sales to a leasing partner, in accounting, you're recording it as a borrowing money from a leasing partner. So there are going to be a lot of challenges. There are going to be a lot of discussions with your fellow accounting professionals or even attorneys working for that company. It's a very interesting profession. So I really enjoy being in this profession. I enjoy teaching accounting. So hopefully you are on the same page as me. Even though this is the introductory course, you are going to enjoy a lot of things as you move forward with your career in accounting, in the intermediate course, and advanced accounting. Okay? Any questions? Any leftovers that you wanted to go over before we move on to the substantive matters? Okay. So capturing transactions in accounts. So I covered this previously. So with respect to accounts, we're going to be using asset accounting items, liability accounting items, or stockholders equity accounting items. So examples were cash, supplies, equipment, accounts payable, sellers payable. So again, your job for this today's lesson is to be able to use appropriate accounting items for appropriate business transactions going forward. And this was the one that I talked about previously. The chart of accounts lists all the accounting names and items that you will be using throughout the semester. So hopefully you find the chart in your textbook and familiarize yourself with all the accounting names that we use. Okay. Analyze the impact of external transactions or business transactions on the accounting equation. So I explained this previously. Each transaction will have a dual effect on the basic accounting equation, meaning that if you are increasing an asset, there will be something that's increasing liability or increasing shareholders' equity or decreasing the assets by the exact same amount, okay? So if total assets increase, then liabilities or shareholders' equity should increase by the same amount. Same goes the other way. If the assets decrease, either the liabilities or shareholders' equity should decrease by the same amount, okay? Understanding effects of transaction. So whenever you encounter a business transaction, you have to ask, I don't want to say 3 or 2 questions. What is the one account that is affected by this transaction? What is the other account that is affected by this transaction? Okay, these 2 questions should always pop up in your head as soon as you read the business transaction. Am I going to be using cash? Am I going to be using accounts receivable? Am I going to be using inventory? So whenever you read a business transaction or encounter a business transaction, that should be the first thing that comes into your mind. What accounting item am I going to use in order to record a journal entry. And the follow-up question is, by what amount am I going to be recording it, okay? So I'm going to use that strategy to record journal entries for these, okay? So there are some examples that are provided here. So let's go over each individual transactions. So according to this, the company sells shares of common stock for $25,000 to obtain the funds necessary to start the business. So basically that's common stock, a company issuing a common stock to investors. So let me just use this. So page 11, companies selling common stock for 25K. So that should be in cash. So what's increasing is cash by $25,000. Okay. Also, since the company is issuing common stock, you're going to be increasing common stock by the same amount. Okay. So we have two increases, asset, not as cash is an asset. Common stock falls under shareholders' equity. Okay. When we increase an asset, that's debit. When we increase shareholders' equity, that's credit. So the journal entry for that particular transaction is debit cash by 25K, credit common stock by 25K. Easy stuff, right? Any questions with respect to this particular transaction? Okay, so let's move on to another transaction. Okay, so basically the slides are breaking down. So one account affected by the transaction is of course cash. The other account affected by the transaction is common stock. So you're recording this. Basically, the accounting, according to the accounting equation, assets equals liability per shareholder security. When you increase an asset by 25, there should be an increase of 25 in either liabilities and shareholders' equity. And of course, common stock falls under stockholders' equity. So these accounting equation balances, okay? So common mistake, sometimes tempting to decrease cash as a way of recording investors' initial investment. So basically this statement is saying that you are a company, not an investor. So whenever you're recording a journal entry, think of what perspective, what point of view you're recording the journal entry from. Are you a company receiving cash for an investment, or are you an investor making an investment to a company? Depending on what perspective you are at, the journal entry will definitely be different, okay? So, I mean, for example, if you're a Starbucks selling coffee, you're going to be recording a revenue. But if you're a customer to a Starbucks buying coffee, you're going to be recording an expense. Similar idea here. So depending on whether you're a company receiving an investment or an investor making an investment, the journal entry will be totally different. Okay? That was the mistake. So next one, transaction 2. You are borrowing money from the local bank and sign a note promising to repay the full amount of the debt in 3 years. So for that transaction, what you are going to be experiencing as a company, since you're borrowing money from a bank, there is going to be an increase in cash. Okay, you are borrowing money, so increasing cash by $10,000. And you are incurring a note, okay, right there. You're signing a note promising to repay. So that's an obligation to pay. So that's a liability increase, notes payable by the same amount, 10K, okay? Cash is an asset, notes payable is a liability. I hate that. So when you have an increase in asset, that's debit. When you increase a liability, that's credit. So you are recording debit cash by $10,000, credit notes payable $10,000. Okay, easy peasy, very easy, right? Now, Let me just talk about one small detail here. So here, notes payable. Remember when we prepared a balance sheet, there are 3 sections, okay? Assets, liability, and shareholders' equity. And you have current assets, non-current assets, current liability, non-current liability, okay? Or it could be long-term, non-current liability or long-term. Usually the cut line is, or the criteria is 1 year. If you have a liability that needs to be paid within 1 year, you report it under current liability. If you have a liability or you have an obligation to pay back in 3 years, like here, 3 years, you're going to be recording it under non-current liability. So this notes payable will be reported under non-current liability of $10,000. Okay. Now, let's say this is year 2020. Okay. Let's just change our perspective to balance sheet 2022. Okay. In this case, this notes liability will be reported under current liability section, because at the end of the year 2022, this note will be due in 1 year. Okay, time has progressed. It's been 2 years since you hold that notes payable. So at the end of 2022, that notes payable, the exact same notes payable, will shift from non-current liability to current liability, again, because that money needs to be paid within 1 year. Okay, any questions? Okay, very good. So transaction 3, purchase equipment necessary for giving soccer training. So you are purchasing equipment for cash. So what's happening here is this: you are using your cash or decreasing cash by $24,000, but at the same time, you are increasing equipment by increasing your buying new equipment with the same value, 24K. Okay, so that's an asset decrease. Also, that's an asset increase. So when you decrease assets, you're going to credit. When you increase asset, you're going to debit. So what you're going to be reporting is debit equipment for $24,000, credit cash for the same amount. Okay, debit equipment 24, credit cash 24. Okay, easy, right? So concept check. What would be the effect of total assets if a company purchased land for $200,000 cash? So let me just write a journal entry for 17. You are using your cash for 200K, but you are increasing land, which is an asset. You bring the benefit by purchasing a land by the exact same amount. So same goes here. So debit land by $200,000, credit cash by $200,000. Okay, so the asset would go up, no, asset increase, asset decrease. So at the end, the net change or zero effect on total assets, because assets are increased and decreased by the exact same amount. Okay. Any questions on so far? Okay. So for after each transaction, the accounting equation must always remain in balance again. So assets equals liability plus shareholders' equity. These balance should always equal to each other. Okay, that's the whole point of the accounting journal entries, accounting equations. Let's go on to another transaction. Whoa. Okay, there you go. So pay 1 year of rent in advance, $6,000. So that was an example, paying something in advance. So prepaid rent, prepaid insurance. So what you're going to be recording is this. So page 19, you are spending cash, okay, for $6,000 because you're paying something in advance, but at the same time, you are increasing prepaid rent, okay? And again, prepaid rent, prepaid expense, prepaid insurance, these are assets. Instead of paying something in advance, you are having that assets, okay, for the coverage of next 1 year, for example, in this example here, by the same $6 amount. Okay, so since this is an assets, you're going to be recording debit, prepaid rent by $6,000, credit cash by $6,000. Okay. So again, as long as you can remember the specific accounting item to use in order to write journal entries, you're pretty much in good shape. Okay. Next transaction. Purchase supplies on account, $2,300. Now, I want to explain one thing before we get into the actual journal entry. So whenever we say on account, okay, on account, so that basically means the company is promising to pay back in near future. So think of it as a credit card purchase. So a customer, excuse me, a customer can use the credit card to purchase something, right? So for example, Starbucks, a customer can use cash to buy coffee, or a customer can use credit card to buy coffee. So think of it as a credit card. So when a company purchase supplies are an asset, because with supplies it's a benefit you can use for something good. Okay, so supply is an asset by 2.3K. Now, what's the other journal entry accounting item they're going to be using? You have something payable. You need to pay for supplies in your future. So you're going to be using accounts payables by $2,300. Okay, accounts payable is a liability item. Supply is an asset. So what you're going to be recording is supplies. Okay, it's a debit item, 2.3K. This is a liability increase, so credit accounts payable by the same amount, 2003K. Okay. Any questions so far? Good. So this was explained previously. So you can expand or break down one shareholder's equity into common stock and retained earnings. You can break down retained earnings into net income and dividends. Net income can be divided into revenues and expenses. So we can play around with the equation to complicate stuff. I don't want to complicate it, but the students sometimes get complicated with the variations with respect to the accounting equation. Okay, but as long as you know how the flow goes here, it shouldn't be any problem with in terms of solving questions. Okay. Okay, so revenues, so retained earnings is net income falls under retained earnings. Net income revenues will increase net income, which will increase retained earnings. Expenses will decrease net income, which will decrease the retained earnings. Dividends just decreases retained earnings. Okay. Another transaction. So provide soccer training to customers for cash, $4,300. So this is an interesting transaction. Okay, 23. Let me just go up a little bit. So essentially what you're doing is providing service to customers. Okay, so by providing service, you're going to be receiving cash, okay, for $4,300. And since you're providing service to a customer, you are increasing revenue. Not or recognizing revenue, not increase, but technically, but increasing revenue by the same amount, $4,300. Okay, this is part of the shareholders' equity. Cash is an asset. Okay, so you're going to be recording journal entry debit cash by $4,300, credit revenue, or specifically service revenue, by $4,300. Okay. Provide soccer training to customers on account. So previously you're providing service for cash. Now you're providing service on account. So basically on account using credit card. So basically the customer is using credit card to pay for the service. So 24, erase mode. What are you doing? Okay, so in this case, since the customer is using credit card, you have some receivables, okay? Instead of recording cash, you have some receivables for the amount of $2,000, but you're still providing service. So you incur revenue by the same amount. So the journal entry is accounts receivable by $2,000. You're going to be recording service revenue by $2,000, debits and credit. Okay. So by slightly changing some details, okay, the journal entry will become different, okay, depending on how you interpret the transactions, okay. Transaction 8, receive cash in advance for 12 soccer training sessions to be given in the future, $600. So this is very interesting transaction. Let me just summarize. So basically what's happening here is that as a company who are providing a service to a customer, you are receiving cash in advance. So it's not you paying cash in advance, like prepaid insurance or prepaid rent. You are actually receiving cash in advance from a customer. What that means is that you have an obligation to provide the soccer training service in the future. Okay, so that's a liability. Now, what accounting item are you going to use to record this transaction? It's called earned revenue. Okay, revenue. So even though I have this term revenue in my accounting item, that does not mean this accounting item will fall under income statement. Unearned item or unearned revenue is a liability. It is unearned yet. So you have an obligation to provide soccer training service in the future. It's a liability. Okay, so something unearned, or some other textbooks, or some other depending on who's in charge of accounting department. Some people say unearned revenue. Some other people will say deferred revenue. Okay, what's going on? Revenue, deferred revenue. So, I mean, the accounting names should not matter as long as it is consistent, but unearned revenue or deferred revenues are the accounting items. That's liability. You're obligated to provide service by receiving cash in advance. Okay, so since you're receiving cash, there is an increase in cash by $600. You're going to be increasing liability, unearned revenue by $600. Okay, so with respect to the actual journal entry, you debit cash $600. Liability credit, unearned revenue, $600. Okay. Any questions with respect to this unearned revenue or deferred revenue?
Yeah, just one question. Like a lot of these example questions, they don't have necessarily like a date frame. Like, do we just expect it to be kind of like end of year kind of scenario?
No. I think I forgot to mention this. So what we're doing is during the period. So whenever there is a transaction, this is what the journal entry looks like.
Okay.
Yeah, but there are going to be, so chapter 3 is going to be on, at the end of the period, you're making some adjustments to these journal entries, but that's whole another chapter. But what we are learning today is what we are going to be recording at the point of the business transaction. Okay. Any other questions? Okay. So deferred revenue. So don't let the accounting name fool you. So even though it says revenue does not mean it will be reported on the income statement. It's a liability. You have an obligation to provide a service. Okay. Whoa. Many transactions. So imagine you're a company. There are going to be a lot of transactions. Okay. So that's why we need accounting professionals. Even during the recession, even during this coronavirus season, you still have lots of business transactions going on in the real world. And that's where you guys comes in as accounting professionals to record these individual accounting transactions. So basically you pay salaries to employees. So very easy stuff. 27. So when you pay salaries to employees, you're going to be using your cash. Okay, so decrease cash by $2,800. Now, if you are paying salaries, what's you're going to be recording is salaries, expenses, because you're using your now I want to say you're using employees. No, I don't want to say using employees, but you benefit from the service provided by the employees. Okay, so I want to be politically correct. So salaries expense. So you are recording debit, salaries expenses by $2,800, debt credit, cash, $2,800. Okay. So cash dividends of 2,000. So sometimes companies issue dividends or declare dividends and pay some cash to investors who are holding your stock as an appreciation for an investment. So when companies pay cash for dividends, you report debit dividends by $200, credit cash $200. Okay. What effect does the payment of dividends have on the accounting equation? So let's look at this. So asset equals liability plus shareholders' equity. So since you're spending cash, asset decrease. Since you are dividends is part of the shareholders' equity. Since you're debiting it, you're also decreasing shareholders' equity. So asset decrease, shareholders' equity decrease. Okay. Debits and credits. Pretty much something that I covered. So how are you going to use debits and credits to record journal entries? This is basically the table that I used or drew about an hour and a half ago. So basically, if you increase asset, you are debiting asset. When you decrease an asset, you debit or you credit the asset. Okay, so make sure you memorize these arrows. If you increase, what are you going to be using? A debit or credit? If you're decreasing, are you going to be debit something or credit something? So you need some practice in order to be able to freely apply these debits and credits for individual business transactions. Okay. And this was the flow. So you can break down shareholders' equity into common stock retained earnings. You can also break down retained earnings into revenues and expenses and dividends. So maybe this figure can help you with respect to understanding and memorizing what's debit and what's credit, depending on what's increasing and decreasing with respect to individual business transactions. Okay? Any questions? Okay. So what does the word debit mean? This is a poor example. I don't know. So basically debit, you increase assets, decrease liability and shareholders' equity. I don't want to say left side, right side. But what that means is basically is this 34. You have T account, okay? So you have cash, you have another T account for accounts payable. For example, left side is always debit side, right side is always credit side, okay? That's what debit and credit usually refers to, okay? Journal entries, okay? So this is the usual structure of journal entry that I'm familiar with, that most of the accounting professionals are familiar with. So you have the date. On the first line, you record debits with accounting names. And on the second line, you are going to be indenting to the right, okay? And then use the accounting name to indicate credit. And on the far right side, you're going to be recording the dollar amount. Okay, and there could be multiple debits and multiple credits, but that's for another chapter. But keep in mind that there could be multiple debit items and multiple credit items depending on the business transaction. Okay. So I did. So basically, I'm repeating myself. So the company sells shares of common stock to investors for cash. So cash increased by 25, common stock increased by 25. Okay, so this was the journal entry that I recorded about 30 minutes ago.
I just have a quick question about
Sure.
this. We might cover this in later chapters, but in this course, we go through I guess par value and additional paid in capital, or is that later?
Yeah.
Oh, cool.
Yeah, but that's for another chapter. Yeah, but par value, additional paid in capital. So I mean, this is just the beginning, chapter 2. So we just dumping everything into common stock category. But what actually goes on within the common stock, they're going to be par value of each individual common stock, and they're going to be additional paid in capital accounting item that we'll be using to report the investment by the investors. Okay. Any other questions? Okay. Posting transactions to general ledger. So general ledger, like I said previously, is basically summarizing all these business transactions and journal entries by accounting items. So here we have been recording debits and credits for cash, revenue, accounts receivable, and service revenue. For general ledgers, basically we are creating, page 39, we're creating a ledger account for cash with all the numbers, for example, 40, 50, 25, that we reported so far throughout the journal entry. And at the end, we want to see the balance, whether we have a debit balance of something or credit balance of something for the particular accounting item. So there could be cash general ledger, there could be accounts receivable general ledger, there could be accounts payable general ledger. Okay, so basically, again, it's an aggregate. It's the summary. Wow. Okay, Google Home Mini. Hey, Google, stop. Wow, interesting. Okay, so you have an accounting title, for example, cash. You describe the transaction, and you report the number for under debits or credit, depending on the business transaction. Okay. Any question? Okay. So posting. So here, for example, if the company records a journal entry of debit equipment 24, credit cash 24, you are going to be posting these two accounting items into two T accounts. As you can see, you have cash. Since you're crediting cash by 24, you're going to be recording 24 on the right side, which is the credit side, 24. Since equipment is a debit item, it's an asset. So when you debit 24, you're going to be recording 24 on the left side of a T account, okay? So same thing goes here. So prepaid rent, you debit $6,000. So for that general ledger of prepaid rent, you're reporting $6,000 on the left side of the T account. Cash, $6,000 on credit. So you report $6,000 on the right side of the cash ledger account. Okay. So basically similar idea. Cash, $4,300 debit, you report it on the left side. Service revenue, credit. So for that service revenue, you report it on the right side of the T account. Okay. So I'm just gonna skip this. Basically, same idea. So basically, these are the answers to what we've been doing for each transaction. So I don't want to go through them again, but when you are reviewing today's lecture, whenever you have questions with respect to these journal entries, always shoot me an email, or you can ask me next week in the beginning of the class. Okay. So which of the following is used to provide a chronological record of all transactions affecting a firm? So basically journal entry that we are using. Okay. Which of the following accounts would be debited when a company pays $12,000 in advance for 1 year of rent? So basically you are paying in advance. So 52. If you're paying something in advance, you're going to be recording prepaid rent by $12,000. Since you're paying, you're going to be spending your cash by $12,000. Of course, that's credit, that's debit. Okay, so this is the journal entry. So journal entry is the key to accounting. You're going to be learning and recording journal entries in my course, in the intermediate accounting course, in the advanced accounting course. So it is very important that you practice as many journal entries as possible in order to best prepare you for the next course, which is intermediate accounting. Okay. Trial balance. So basically trial balance, we've been learning journal entries. We've been learning journal ledgers. What trial balance does is to put everything under T accounts. So like I said previously, you have debits and credits here. So disregarding this accounting item, so we don't regard this for trial balance. Instead, you are going to be recording all the debits and all the credits and see whether these two balance each other. This is what the T balance, trial balance looks like. I don't know whether I have an example, but let's say, for example, you have cash 3, cash 4, accounts receivable 5, accounts payable 7, equipment 7. So disregarding all these accounting items that we've been using so far, you don't care about that. As long as the sum amount of all debits equals to the sum of all the credits, that means you are doing something correct. Okay, if these two does not balance, that means you made a mistake when you're recording a journal entry. Okay, So the reason why we do trial balance is to make sure that all the journal entries that you recorded so far is correct. Okay. Which of the following accounts would appear in the credit column of a trial balance? So basically anything that you're recording a credit will be on the right side of the trial balance. So prepaid rent is an asset, so it's a debit balance item. Dividends, it decreases shareholders' equity, so that's a debit item. Common stock, it's shareholders' equity, so it's a credit item. Okay. Oh, credit item, salaries expense, but common stock. Okay. Interesting. Why does the common stock not appear on tribal? I'll have to get back to you. I don't know why common stock does not appear in the credit column of a trial balance, but I'll get back to you later on. Okay. Any questions so far?
So why is I'm sorry, why does salary expense appear on the credit side? I thought a salary expense.
Oh, that's right. Salaries expense is a debit item, debit balance item. So basically, I guess this is so common stock is the answer. Salaries expenses are debit items. So you're right. So common stock is the answer. Good catch. Any questions? Okay. So the rest are some practice problems that I prepared. So practice always makes perfect.
Is dividends the same as an owner draw?
Dividends.
Yeah, I mean, I know what a dividend is from a corporation, but if you're privately held, would that be the same as an owner's draw?
If it is privately held, depending on whether it's a partnership or sole proprietorship, if it is a sole proprietorship, there's no dividends. You're the owner. You're the single owner. Partnership, you don't say dividends. Well, you call it the shares, I guess. The share is the term that you'll be using.
Okay, but dividends are debit.
Dividends, yeah. Basically, it reduces shareholders' equity, so that's a debit balance item.
Yes.
Mm-hmm. So something reducing shareholders' equity, so that's debit.
Yes.
Mm-hmm.
Okay.
Yeah.
Right.
Any other questions? Okay. So up until this point, I've covered the conceptual level of accounting journal entries and debits and credits. What you need to do going forward is to practice as many transactions as possible in order to be able to basically play around with journal entries. So let's try with some of the examples here. So this company purchased office supplies on account for $400. So 56. If a company buys supplies, that means an asset increase or supplies increase by $400. Since it is on account, you're using your credit card to purchase supplies. So that's accounts payable increase by $400. So for journal entry is debit supplies. Okay, 400, accounts payable 400, credit. Okay, so going forward, I'm not gonna indicate whether it's an increase or decrease. I'm just gonna say debits and credits. Okay, to basically help you get used to the terms debits and credits. Okay, this was number one. Number two, purchase equipment in exchange for cash of $15,000. So you're spending your cash to purchase equipment. Both are assets. So you debit equipment of $15,000. You use cash to purchase that equipment. Okay, so you debit credit. Okay. Provide services worth $800 to customers on account. So basically, let me go up a little bit. Basically, you're providing service, customer pays using credit card. So you have some receivables, okay, by $8,000. Since you're providing service, you report service revenue of $8,000. Okay. Paying employee salaries for $2,400 for the current month. So basically, you incur salaries expenses by 24, since you're paying cash for the salaries 24. Okay, so your job at this point is to be able to instantaneously come up with the accounting items to record journal entries. Okay. Number 5, purchase advertising for the current month for $500. So advertising, what accounting item that you're going to be using? Basically, it's advertising expenses. $500, you're using cash. Okay, cash decreased by $500. Okay. So even though the problem set provides these accounting items for your quiz, for your homework, for midterms and finals, we are not going to provide you the examples of accounting items. You have to be able to come up with these accounting items on your own in order to record a journal entry. Okay. Let me provide some of the business transactions. Okay, 57. Go up. Purchase supplies on account. So I'm going to go over that very fast this time. So you're purchasing supplies. So asset increase by $1,500. Since you're using credit card to purchase something, that's accounts payable, $1,500. That's number 1. Or March 5th. Number 2, provide service, that amount to customer and receive cash. So you're receiving cash means debit cash, $4,300. You provide service, so that's service revenue with $4,300. Number 3, pay utility bill for current months. So when you're paying something, means credit cash, $450. Since it is related to utility bills, I think the accounting item that you're going to be using is utilities expense, $450. Okay. March 25th, providing service on account. So basically you are recording something receivable of $1,800. Since you're providing service, you're going to be recording service revenue of $1,800. Okay. 5, pay workers salaries for the current month. So very similar. So salaries expense. 3,800. Since you're paying using cash credit by 3,800. Okay. Pay current months. So far we've been talking about paying cash in advance for the rent, but now in this case you're just paying rent for this month. So basically it's rent expense by $1,200. You're paying using your cash, so $1,200. Okay, so depending on whether you're paying for rent in advance or paying for current month's rent, the journal entry that you're going to be recording may look very different. Okay. Any questions so far? And if I'm going too fast, just let me know. Okay.
I have a question about supplies.
Supplies.
Yeah. In this example, you have purchase supplies of $1,500, right?
Mm-hmm.
And in the previous example, it was purchase supplies of $400. Supplies, is it expense or is it account in this case?
So when you purchase supplies at the point of the purchase, this is what you're going to be recording. But next chapter, we're going to be learning something called adjusting entry.
Mm-hmm.
Okay, adjusting entry, meaning if you buy supplies, of course, you're going to be using your supplies, right? So when you're using supplies, you're going to be recording supplies expenses by some amount, and you're going to be crediting supplies because as you're using your supplies will decrease. So you credit supplies, but at the same time, you're going to be recording supplies expenses. And that's what we call an adjusting entry. That's for next chapter.
Thank you.
Mm-hmm. Any other questions? Okay. Whew, more examples. I prepared some. Oh, we are almost there. Okay. So let's go over page 58. Issued 20,000 shares of common stock for $50,000 cash. So when investors buy your common stock, you're receiving cash by $50,000. And at the same time, you're going to be recording common stock with $50,000. Okay. That's transaction number one. Transaction two, hire 2 employees with each earning $1,500 per month. So number two is a very tricky one. When you hire employees, you do not record any journal entries. At the point of hiring new employees, there's no service. There's no paying for salaries. There is nothing going on with respect to revenues, expenses, assets, liabilities. So for number two transaction, you do not record any revenues, okay? So the fact that you're just hiring new employees, it doesn't affect anything with respect to assets, liabilities, revenues, and expenses. So number two, we do not record any journal entry, okay? Number three, purchase equipment for $15,000 cash. So since you are purchasing equipment will increase by $1,500. You're using cash to purchase the equipment, so credit cash. Okay. Number four, purchase land for $25,000. A note payable is signed for this amount. So note, you're promising to pay back in the future. So land is an asset. So you're going to be recording land for $25,000. Since you're signing a note, you're going to be recording notes payable, $25,000. Okay. 5, purchase office supplies. Very easy. Supplies, $1,500 on account. So you have payables, $1,500. Okay. Now, I think I didn't talk about this. So what's the difference between accounts payable and notes payable? So the easiest way to differentiate between accounts something or notes something is that accounts you usually pay back within 30 days. And that's note for something related to notes, that's usually beyond 30 days. Okay. That's usually the criteria that I use in order to identify whether it should be notes or accounts payable. Okay. 6, receive cash in service fees earned during the month. So you are receiving cash, so debit cash by $10,000. Since you are providing service, you report service revenue by $10,000. Okay. Last transaction. Well, okay. Pay employee $3,000 for wages earned during the month. So since it is salaries, you report salaries expenses by $3,000. You're going to be using cash to pay for salaries. Okay, very easy. Any questions? Okay, so a few more problem sets. Which of the following transactions increase total assets? Provide service to a customer on account. So that's accounts receivable increase and revenue increase. So it will increase total assets. Purchase supplies for cash. So let me just write down in order for you to understand better. So when you provide service to a customer on account, you record accounts receivable by some amount and revenue some amount. So this one increases an asset. So I think this is the answer. Purchase supplies for cash. So when you purchase supplies for cash, means supplies will increase, but cash will decrease. So it's an asset increase, asset decrease. So total assets will not change. Okay. Collect cash from customer for services provided on account last month. So basically, this is tricky. So collecting cash from customer for services provided on account last month. So let me just go back last month. Last month, the company should have recorded accounts receivable by X amount and revenue by X amount for providing the service. Okay. Now this month, what the company is saying is that last month I have some receivables. Now I'm receiving or collecting the cash from the customer, okay, for the services. So this month my cash will increase by the X amount. My accounts receivable will decrease by X amount because I am receiving or collecting the cash that the customer owed me from last month. Okay, so this is asset increase, asset decrease. So total asset will not change. Okay. Pay dividends to current stockholders. When you pay dividends, cash will decrease. So total assets will decrease. Okay, so the answer is A, or the first business transaction. Okay. Which of the following transactions increase total liability? So let me just pinpoint one. Paying for cash in the current period. So that's an expense, pay for rent, but you're using your cash. So assets will decrease, shareholders' equity will decrease. It has no impact on liability. Purchase equipment with cash. So equipment will increase, cash will decrease, asset increase, asset decrease, no impact on liabilities. Pay dividends to stockholders. So cash will decrease, dividends retain. So that's part of the stockholders' equity. So no impact on liabilities. Purchase office supplies on account. So when you're purchasing supplies, you have payables. Okay, you're using your credit card. So that will increase your liability. So the answer is D. Okay. Which of the following transactions will decrease stockholders' equity? Let me briefly go over. So here, so when you pay salaries, okay, for employees, you are going to be reporting, let me just go here. 61, you're going to be reporting salaries, expenses, and cash by X amount. So this salaries, expenses, it's part of the net income. Net income is a part of the retained earnings. Retained earnings is a part of the shareholders' equity. So by reporting expenses, you're going to be decreasing stockholders' equity. Okay, so the answer is B. Next, purchasing land with cash would have what effect of the accounting equation? So let me go down a little bit. 62, when you purchase land by X amount with cash, cash will decrease. Okay, so it's asset increase, asset decrease, so no impact, no effect on assets. Okay, so the answer should be D. Okay, any questions so far?
I have a question about
Sure.
you remember you showed us a table that says when dividends increase with credit, right?
When dividends increase, you debit.
No, but in the table it was dividends. No, this journal entry it shows when you pay dividends to stockholders, right? You debit dividends and credit cash, correct?
Oh yes.
Yeah, but dividend increases with credit.
No. When you report dividends paid to investors, you debit dividends and you credit cash.
Yeah, but remember you showed us a table when, for example, in the very beginning you said to remember it.
I think you're referring to this.
I think she's referring to the fact that on your notepad in the beginning, I think you made a mistake where you put dividends and expenses. You put debit and credit. And I think
Dividends,
that's what she's referring to, I
Whoa.
believe.
Okay, let me go back. Whoa, I wrote a lot of things.
Yeah.
Oh,
Yeah,
I
like,
think here.
yeah, I think that's what she meant.
Let me go back. Oh, okay. So I think this is what you mean. Okay. So how should I explain this? So this is a negative sign. So technically you have to flip this too. Okay. And same goes here. So this is a negative. So this one should flip as well. If this one's confused you, forget about this. Focus on this.
Okay, thank you.
My bad. Okay.
Thank
But
you.
when you're paying dividends, when you're reporting expenses, it's debits right here. Okay. Any other clarifications, questions that I need to make? Okay. Whew. Let me. I forgot where I was. Okay, let me just catch up from here. So which of the following is possible for a particular business transaction? Okay, so let me go down. Okay, so 64. So increase asset, decrease liability. Oh, okay, so this is basically accounting equation. Okay, you have this. Number one, when you increase assets, you cannot decrease liability. This won't not hold, okay? So no, it's not gonna work. When you decrease assets, increase shareholders' equity, no, this is not gonna work. Decrease assets, decrease liability. Yes, if you decrease on both sides of the equation will still hold. So this one looks good. When you decrease liabilities and when you increase expenses, that means you're subtracting numbers from shareholders' equity. So that's also decreasing. So this one does not make sense. So the only thing that is possible is the third one. When you decrease assets, you can decrease liabilities. Okay. Which of the following accounts normally has a debit balance? So when something has a debit balance, it's usually the assets or expenses or dividends. So payable, this is liability, so it's a credit balance item. Common stock, shareholders' equity, so it's a credit balance. Supplies is an asset, so it's a debit balance item. Service revenue, this is part of the shareholders' equity, so it's a credit balance item. So the answer is C, supplies. A debit is used to decrease. So when debit is used to decrease, that means you're talking about liabilities or shareholders' equity, okay? When liabilities decrease, you debit the liability. So the answer is accounts payable. Okay. Providing services to customers for cash would be recorded with, so let me just simply write here, 67. Providing service for cash, so you have cash increase and revenue increase. Okay, so you debit cash, you credit, okay, service revenue looks good. Nothing related to expenses, nothing related to receivables because you're receiving cash for the service. Okay. Which of the following transactions cause an increase in stockholders' equity? When stockholders' equity increase, you either report revenues or common stock. So obtain cash by borrowing money. So that's an asset. Borrowing money, that's liability. Paying dividends, so that decreases shareholders' equity instead of the increasing shareholders' equity. Providing services to customers on account, so that's an asset increase because you're reporting receivables. Providing service, that's a revenue, so revenue will increase stockholders' equity. So answer C. Okay. Purchasing, advertising, local station. So basically, advertising is an asset because by advertising your products, you are getting some benefits. Okay, so that's an asset. Since you're purchasing something, probably you're using cash. So that's an asset decrease. Okay. Whew, that was some of the examples. So I really strongly emphasize the importance of you guys practicing and exposing yourselves to a variety of business transactions. And it's very important that you are able to record different types of journal entries throughout the rest of the semester. Okay? So any questions? Any questions? Okay, so I think we are ending our class a little bit early. So we have 2 students who volunteered to present their extra credit presentation. Let me just open up. So I don't know what students, we have Mahfouz and Stanislaus presenting. So let me, do we have Mahfouz, Haku, here?
Yep, I'm here.
Okay, did you prepare something?
Yes, I did.
Okay, I think the screen share function is not available to participants. Can you share your screen?
Okay, give me a moment to try.